In this video, I'm going to be revealing the best ways of using support and resistance to assist you in making better trade decisions. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. Let's get into today's video. Support and resistance levels are the most important technique to master when trading using technical analysis, but 99% of traders still get it wrong. Why is it very important to understand? It's because once an area of support or resistance have been identified, it can serve as a potential high win rate trade opportunities. Like in this example. In this chart, we can spot that there's an area of resistance here as prices went up to this level and reverses downwards. So the next time when price hits this level again, there's a high chance that it's going to reverse downwards again. So this can be a possible trade opportunity. That is why support and resistance is very important. A common mistake that I see traders make is that they draw too many lines like this. We can all agree that this looks really confusing. A correct support and resistance line is meant to make your analysis easier, not to confuse you. The reason that traders do this is because they don't follow the secret rules of support and resistance that I'm going to reveal to you right now. So the first criteria that validates a level of support and resistance is multiple rejections. Let me show you what I mean. In this chart, we can see the price went down to this level 3 times before reversing back up. So here are multiple rejections. So we can draw a support line here. You can also see this happening on the top. Every time prices went up to this level, it reverses downwards. You can see this happening many times on 3 different occasions, so we can draw a resistance line here. You may be wondering that prices don't always reject to one level. So we need to bring us the second strategy. The moving average strategy. Moving average is the most practical technical indicator. And it's widely used in daily trading analysis and helps traders to identify market trending. You can click here to watch my video and get more moving average strategies. We all know that simple moving average calculates the total of the data and smooths the price fluctuations out accordingly to the period of the moving average. When it comes to exponential moving average, it is more reactive to price and calculates the current data in which is closer to the current price action. So we can say that prices are always act around the moving average line. Here I use EMA 21 as example. In this chart, we can see, when prices go downwards, prices are under the moving average line. The moving average line becomes the resistance to prices. On the other hand, when prices go up, prices are up the moving average line. The moving average line becomes the support line to prices. But what you need to pay attention to is moving average would not work when market is on a range market. And using moving averages as support and resistance line tends to be lag. Here I will introduce a strategy to draw support and resistance lines that rarely known. The name of the strategy is Fibonacci Retracement. The Fibonacci ratios are a very powerful tool that can help you in identifying and pinpointing market reversals with ease. Let's first understand the basics of Fibonacci, and then we will proceed to advanced trading strategies using the Fibonacci ratios. Fibonacci ratios origin from the Fibonacci number series. The Fibonacci number were created by an Italian mathematician named Leonardo Pisano. The numbers start from 0 and then they keep on adding the values of the previous 2 numbers in the sequence. For example, 0 plus 1 is equal to 1. Then 1 plus 1 equals 2. 1 plus 2 equals 3. 2 plus 3 equals 5, and so on. Any given Fibonacci numbers is the sum of the previous 2 Fibonacci numbers. They are magic numbers because they are seen in various aspects of our life. Ancient architecture, petals of flowers, the shape of our faces, and even body are all in some way associated with Fibonacci. Therefore, some people state that the prices of any assets might also be moving in relation to Fibonacci. If you calculate, you will find that any given number in the Fibonacci series is around 1.618 times the previous number. Therefore, the number 1.618 is called as golden ratio. Now let's understand how Fibonacci numbers in our daily trading to find support and resistance levels. If you are trading for a while, you will know that the price of any asset does not move in a straight line. The price always moves in a zigzag fashion. Every time the price makes a huge move, there is always a pullback that follows. As a trader, we want to catch these huge impulsive moves. But the question is how we enter in right on time. That is the Fibonacci retracement tool works. When the price is in an uptrend, first we see that it makes a huge up move. Then we see a small down move. This down move is essentially a pullback. The Fibonacci retracement tool will help us in finding potential areas where the price might find support during this pullback. On the other hand, in a downtrend we see the price makes a massive down move. Then we see a pullback, which is this up move. The Fibonacci retracement tool will help us in identifying potential areas of resistance where the pullback might come to an end. The price might start another down move. When you use Fibonacci retracement tool, you will find that there are several levels on it. But most of levels are useless. I prefer 0.382 and 0.618, these two levels. I suggest you to remove all the other levels from your tool. Now to Fibonacci retracement tool, we first need to plot the retracement tool correctly. Take downtrend as example. We first need to identify the most recent major swing high on the chart. For instance, on this chart, this is the major swing high. Then we need to identify a major swing low, which is this point. Now we select the retracement tool and plot it from the high of the swing high to the low of the swing low. We want to make sure that we plot the tool from the high to the low. The three lines that we get in the middle are the Fibonacci retracement levels. They are 38.2, 50 and 61.8% of the entire move. In a downtrend, the price will find resistance at these levels. As you can see, the price found resistance exactly at 38.2 level. Similarly, in a uptrend, we will reverse the process. First we need to identify the recent swing low. This is the most recent swing low. Then we will identify the most recent swing high on the chart, which is this point. Now we will draw the retracement tool starting from the low of the swing low to the high of the swing high. Then we get three Fibonacci retracement levels. We can see that price found the support at 61.8 level and immediately reversed upwards. A tip must be mentioned is that if the price is in a very strong trend, the price will often pull back very shallow and respect 38.2% level. On the other hand, when the trend starts to mature, the pullback will often find support at 50 and 61.8% levels. In most trends, the prices respect the 50 and 61.8 levels. So these are the strategies I want to share with you in this video. Except these strategies, there are also many strategies to help you to identify the support and resistance levels. In next video, I will tell you more strategies about it. Be sure to subscribe my channel and don't miss it.